Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Hello, everyone. Welcome to today's Savant Live webinar. Thanks for joining us. I'm Dominic Parillo, Savant's Director of Wealth Transfer, and I'm joining you live from our Manassas, Virginia office. Today, we're excited to discuss what to do when you receive an inheritance. And there's really a lot in this topic. And we want to give everyone listening and viewing today a good starting place and some takeaways to further your discussions with your team of financial advisors and other experts. I'm proud to welcome Michael Goldstein to the conversation as well. Michael's a financial advisor at Savant. Welcome, Mike.
Thank you, Don. It's great to be here today to discuss this very important topic.
Happy to have you here. I think this is going to be great. We got a really good program. Just a couple of items before we get rolling with our agenda. If you have any questions throughout today's presentation, there is a Q&A feature at the bottom of your screens. So if you click that Q&A box, you can type in your questions live. At the end of our discussion, we have plans to address as many of the questions live that we can with our remaining time. And also note that this webinar is being recorded. We don't necessarily send out the slides, but you will see a recording in your email that you registered. And this and all the other webinars we've done on different topics are also available on Savant's website. So we invite you to check out www.savantwealth.com so you can see, again, this webinar and other webinars that we've done in the past. But back to today's topic of inheriting wealth. We want to give everyone some good insights into the income, estate, and gift tax, just issues to think about when you inherit wealth. Oftentimes, after you receive an inheritance, it's going to change the paradigm for your own personal estate plan. So proper trust establishment for asset protection and estate tax goals is going to be important for you and your family. Mike's going to give us an overview of some investment considerations and also a little bit about what we do as financial advisors and holistic wealth managers. And then we'll wrap up with a few topics thinking about flexibility and planning for generational wealth. Also, some common pitfalls that we find people run into when they're navigating an inheritance in their own wealth picture. And then again, at the end, we'll have some Q&A. All right, let's get started. So, and I'm sure you get this a lot, Mike, but when people inherit wealth, they usually say, do I have to pay tax on this? How does this work? And today we want to focus on really two different tax systems. You have income tax, which we'll start with, and estate tax or transfer tax. So when you think about income tax is the tax that you pay on income that you earn or tax you pay on investment income like interest, dividends, capital gains. And it also applies to withdrawals from retirement accounts that you might have funded yourself or have inherited from a loved one, for example. So first question again, do I have to pay tax on this inheritance? Typically, when you, at least initially, when you receive an inheritance from a loved one or even a lifetime gift, if that person is still alive, you don't pay income tax, at least initially, on that gift at the time of transfer. But depending on the asset that you received via the inheritance or the gift, you may pay income tax when, for example, if we're dealing with an after-tax brokerage account, that asset in the account is later sold. There's a capital gain that would apply. So I just want to make that distinction clear. The income tax that you might be faced with paying is really going to be dependent based on the type of asset that you inherit. So I mentioned the term after-tax assets. That could be a brokerage account that you inherit from a parent, or maybe that parent had a revocable living trust that owned some various investment securities, mutual funds. Those are after-tax assets. And that means that when money is withdrawn from those accounts and assets are sold, not every dollar is subject to taxation. With an after-tax account, only the appreciation from the time the asset was originally purchased and when it's sold is taxed in the form of a capital gain. Now, what's unique about inheriting an asset is that if these after-tax accounts are included in the person who passed away that you received the asset from's estate for estate tax purposes, there is called step up in basis that applies. So essentially, any built-in capital gains that original owner had accumulated during their lifetime go away for all intents and purposes, because the tax basis that you have as the inheritor of that asset becomes the market value on that person's date of death. So said differently, if mom owned 100 shares of Apple and she paid $20 a share, and now it's worth $600-700, right? If mom would have sold that asset during her lifetime, she would have capital gain based on the difference between original purchase price, current market value. Well, if mom held that asset until she passed away, now your tax basis as the inheritor is that market value, that's $600 or $700, whatever that value is at mom's death. So if you sold it the next day after you inherited it, there'd be no capital gains implications for you as the new owner. Hopefully that makes sense. Now, if an asset is gifted to you during your lifetime, you didn't inherit it on account of death, whatever that original account owner's tax basis or cost basis in that asset was at the time of the gift gets transferred to you as the new owner. So if you were to, again, to sell that same share of Apple, if it was gifted to you during a lifetime, you would have capital gain based on what mom originally purchased it and the market value at the time you sell it. So again, it depends on the type of asset that you receive, whether it was received at death or during a lifetime. That'll really impact the potential capital gain liability that you have if that asset is sold. But at the time the gift is made or the time you inherit it, there is no income tax. It's only when that asset is sold. But even if you hold an asset and you don't sell it, if there are interest and dividends, let's say from an investment portfolio, those interest and dividends would be taxable to you as the new investment holder. And again, that would apply via lifetime gift or at death. So hopefully that gives you a little bit of insight as to how these assets are taxed, and particularly with after-tax assets that you might receive via lifetime gift or via an inheritance at death. Now, the other type of asset that's really common is life insurance. And generally, if you are the beneficiary of a life insurance death benefit, rather, there's no income tax ramifications for you as the recipient. And it's essentially a cash payment, which can then be invested in securities or held in the bank account. The last type of asset that's really common to inherit is a retirement account. And these retirement accounts like IRAs, 401ks, 403bs, these are very, very common for most Americans because this is the primary retirement savings vehicle, right? It's when you are working, you're contributing to your 401k, you're getting an income tax deduction, and then you can also contribute to self-directed IRAs as well, receiving an income tax deduction. The rules are totally different for inheritors of retirement accounts. These are IRD assets, or income with respect to a decedent asset class. And essentially every dollar that you would draw from those inherited retirement accounts is not subject to capital gains taxation, but ordinary income taxation. So every dollar that you would draw ends up going on your tax return as if it was ordinary income, and it's taxed at your marginal income tax bracket based on your other income sources and deductions. And I'll go to the next slide. The Secure Act, many of you have probably heard about this, has really changed the game for how inherited IRA assets can be held and how they're ultimately taxed as an inheritor of these accounts. And the big takeaways are, prior to the passage of the Secure Act, which was in 2019, this law became effective 2020, 6 years ago, if you can believe it. Time flies. But as an inheritor of an IRA account, generally that person that inherited the IRA could defer income tax on that inherited IRA account for their entire lifetime. It was this stretch IRA concept that you may have heard about. The big change with Secure Act is that unless you are a special class of inheritor called an eligible designated beneficiary, you're really limited to a 10-year income tax deferral limit. So the inherited IRA account that you receive has to be fully distributed, and you have to pay all of the income tax on it within a 10-year period following death of the original owner. And that's created a lot of planning issues for inheritors of wealth, having to minimize income tax exposure. So, Michael, you're going to go through a little bit of this in your section, but having a good understanding of the types of assets that you own will also help you come up with a withdrawal strategy that can minimize overall income tax that you have to pay. A little bit more on the Secure Act. I mentioned this class of eligible designated beneficiaries. If you're an eligible designated beneficiary, instead of having a 10-year limit for how long the IRA account can be open, you're still able to use your life expectancy under the old Secure Act, pre-Secure Act rules. So eligible designated beneficiaries are surviving spouses, children who are under the age of 21, so minor children, disabled and chronically ill individuals, or people that are not more than 10 years younger than the original IRA owner. That's typically a sibling or a friend. That's the most common scenario where the inheritor of that IRA is not more than 10 years younger than the IRA. So if you're in these classes of beneficiaries, you can use your life expectancy to take distributions. You're not limited to the 10-year limit. Surviving spouses actually have the most flexibility under the tax code for required distribution purposes. On the next slide, I'm going to give you a little bit more of a detailed view on how to navigate these issues. Again, if you're the recipient of an IRA, but surviving spouses can actually treat an IRA as their own that they inherit from a spouse, add it to their own existing IRA. They can defer taxes based on their life expectancy. They're treated as having owned the IRA from the beginning. So here's a good view on some of the details. Again, this will help guide you if you are an inheritor of an IRA. And I want to point out two sort of spectrums. And this is important if you've received an IRA and you're now the beneficiary of one, but understanding the original beneficiary structure is really critical. In many cases, if people fail to name a beneficiary designation on their IRA account, their estate becomes the default beneficiary. Now, you might ultimately receive an IRA, an inherited IRA in your name as the beneficiary via the estate settlement process. But if an estate was originally named as the IRA beneficiary, you might have completely different rules. It might not be 10 years. It might be a 5-year period that you have instead of a 10-year period if that original IRA owner died before their required beginning date when they had to take RMDs, or if they died later in life after their required beginning date, it might be based on their remaining life expectancy, a period potentially longer than 10 years. So don't always assume if you are not an eligible designated beneficiary that it's going to be 10 years. It really depends on how that original IRA beneficiary designation was set up. Also interesting to note, if a charity is named as an IRA beneficiary on a beneficiary form, the charity does not pay any income tax on the IRA distribution. So essentially, everything is liquidated in the first year, and that retirement income would be payable to the qualified charity, a 501c entity, and there's no income tax payable. That can be important if you are acting as an executor or a trustee and you're trying to quantify any outstanding income tax liabilities you might have to pay before you distribute assets. Again, spouses have the most flexibility. Spouses can treat IRA accounts that they receive as their own, have very flexible income tax deferral. It's also common, I'm going to highlight this in a few slides, for trusts to be beneficiaries of an IRA because it's often important to preserve assets for the family after the first death in the event of a possible remarriage by the spouse. So it's becoming more common for, let's just say, a family trust or a marital trust to hold IRA assets for the benefit of the spouse, even after the first death. And the good news is Secure Act gave us a great gift, a lot of flexibility for that surviving spouse as beneficiary of a family or marital trust that holds an IRA. The trust just has to be drafted properly to allow the spouse to utilize life expectancy and have some of the benefits for income tax deferral that they would have had if they just inherited the IRA directly. So really happy that we got some guidance and clarity on that, because asset protection is becoming increasingly important, just to, again, preserve those marital assets after the first death. If you're a non-eligible designated beneficiary, typically a adult child, again, you have a 10-year time window in which to keep the IRA open. The entire IRA account has to be liquidated and distributed to you within 10 years, and you pay income tax and all those distributions. And that raises some planning opportunities, right? You can do a forecast of your projected income tax brackets and figure out a tax-efficient withdrawal strategy. One thing to note is the timing of when the original IRA owner died is really important for you as a non-eligible designated beneficiary, because if the IRA owner died before they were required to start taking minimum distributions, there is no minimum distribution for you in each of the 10 years as the IRA owner, the beneficiary IRA owner, that is. So you have a lot more flexibility in tax planning. But if that original IRA owner died after they were required to start taking minimum distributions, then there is an annual minimum distribution that you have to take. This is something I think that gets missed all the time. These rules are pretty mechanical, but they're confusing. They really are. So the first step is just understanding what type of assets you've inherited, getting familiar with the tax attributes, and then if you're dealing with an IRA, really reach out to your financial advisor, tax accountant, so you can make sure that you're complying with any minimum distribution rules correctly and not making any missteps when you are taking distributions, because there are potential penalties if you underdistribute IRA dollars. Okay. That was a lot on income tax, so we'll shift gears and talk a little bit about estate tax, because that's the other tax that could apply when you inherit wealth. So estate tax is a tax on the transfer of wealth from a decedent to a beneficiary, often a loved one. And there's two estate tax systems to be aware of. There is the federal estate tax system, and then that person who died, they may have lived in a state with a state-based estate tax. And those state-based estate tax limits, thresholds, and rates vary greatly depending on the state of residence of the decedent. From a federal transfer or estate tax standpoint, each individual in 2020, that should say 2026 on the slide, we'll have to correct that, but everyone in 2026 has a $15 million per person estate tax exemption. So if you're a married couple, that means you have $30 million that you can pass estate tax free at the federal level to anyone, any beneficiary. A single person, again, has $15 million. If you're married, the federal exemption is portable between spouses. So if the first person dies, has less than $15 million in their estate, the surviving spouse can add the unused exemption amount to their own $15 million number at their death. So you don't lose the benefit of the married exemption. And it's indexed for inflation. The federal estate tax exemption increases every year based on CPI. This number is now permanent based on the passage of the One Big Beautiful Bill Act. That's not true for state estate tax. Oftentimes, state estate tax thresholds are much, much lower than the federal threshold. Oftentimes don't have inflation adjustments annually. And in many cases, there's no portability feature. So why is this important for you as an inheritor of wealth? Often the first step when someone passes away before the wealth can be transferred is paying all estate tax obligations, final income tax obligations, funeral, last illness expenses. So if you're wearing an executor or trustee hat, really important to quantify any estate tax obligations that could be out there. Also, you might find yourself in an estate tax situation, especially if you receive a pretty significant inheritance from a loved one. Here's a map of states that do have state-based estate or inheritance tax. Real quick, you might be wondering, well, what's the difference between estate and inheritance tax? Estate tax is the tax on the transfer of wealth, and it's assessed on the estate of the decedent. The inheritance tax is similar. It's actually a tax on receiving wealth, and it's typically paid by the beneficiaries based on the amount of money that they receive at an individual level. So, if you're in a state that has an estate tax and you receive an inherited wealth, even if you're nowhere near that $15 million number for federal purposes as a single person or 30 million married, really, really important to understand how this inheritance is going to impact your own estate or inheritance tax future for your children or their loved ones that you ultimately transfer wealth to. Which leads us to our next topic. There's always, there's never a bad time, I should say, to review your own estate plan, especially after a major life event. Death of a loved one being a big one, but significant change in net worth, which could occur when there is a death of a loved one, changing state domicile, birth of a child, grandchild, a divorce situation. So just a few thoughts with regard to issues you might want to be aware of when you think about your own estate plan when you inherit wealth. So here's some illustrative examples. This is a very typical estate plan that we encounter. Married couple, and there are two separate revocable living trusts. In our example, wife inherited $2 million from her parents, and she has a couple of decisions to make. Well, how should I title these assets? Should I put them in a joint account? Should I keep them in my name? The titling after you inherit an asset has big implications for whether or not that inherited account is going to be includable in a divorce settlement, for example. So before you start titling assets, either in a joint account or in a trust, just be aware that there are some implications based on what that ultimate titling is. Oftentimes, you don't want to commingle inherited assets with marital assets because marital assets that are inherited aren't automatically considered marital property, for example. And the reason I say this is that oftentimes it's important for people that inherit wealth to preserve that wealth for their family and protect that wealth. So, like I said earlier with IRA planning, inherited wealth that you receive can be held in a trust structure that protects and preserves that wealth for a surviving spouse. So there's a little bit more, I guess, certainty or confidence that that wealth ultimately passes down through your bloodline or gets to the people that you care about versus, let's say, a new spouse or some other unforeseen person. So when you inherit wealth, review the terms of your own estate plan. Really think about what this wealth means to you, because it can change a lot, right? It can change your retirement time frame, your investment strategy. Michael's going to go through that a little bit more detail, but big impact on your own personal estate planning objectives. It's also important, like I said earlier, to think about your estate tax picture. So in this example, we have a $2 million estate inherited dollar amount, which is perfect because we have many people we know in the state of Massachusetts. And Massachusetts, coincidentally, has a $2 million per person estate tax exemption. So you might not have had a Massachusetts estate tax problem with your own wealth, but if you receive a significant inheritance, a couple $1,000,000, and that inheritance is given to you outright, well, now that estate tax number is going to be, a real. You're going to have some estate tax exposure. Sorry, I'm stumbling a little bit. So there is an opportunity even before you inherit wealth, if you find yourself in a state with a low estate tax threshold, to maybe coordinate with your own family, your parents, or whomever you're expecting to receive the wealth, because they can create a structure to protect and preserve the wealth so it's not included in your estate for estate tax purposes. And that also leads to just understanding how you can even access these monies. So I mentioned the term outright. If you inherit money and it's just given to you in your name, you basically have free and unfettered use of the assets. It's fully includable in your estate. There's no formalities, no protections whatsoever. But if you inherit the assets in a trust, for example, there's a lot of rules and distribution guidelines that have to be followed. You might not even be the trustee, right? So understanding that structure of the inheritance, I would say equally important. Can I access these monies for any reason whatsoever? Is it limited to, let's say, a health, education, maintenance, support standard? Again, just more issues, more things to be aware of. So it's the types of assets that you inherit, the tax attributes that go along with those different types of assets, and then the structure of the inheritance. Very, very important. Okay. You might think about your own IRA or retirement accounts, because the same issues that we spoke about just a moment ago with regard to your inherited IRA that you might receive are also going to apply to your intended beneficiaries in the future. So you have choices when it comes to naming your own beneficiary designations. If you're a non-eligible designated beneficiary, you are limited to that 10-year window when you inherit an asset. But if it's your own IRA that you funded, that you contributed to, you're going to have income tax deferral for the rest of your life. And this is going to become potentially a large part of your overall estate and distribution plan. So the big choice is, do I want to name my beneficiaries as individual outright beneficiaries on my beneficiary form? Or do I want to have a trust name, for example, to protect those IRA assets? And there's not really a right answer. It's really a trade-off because of the income tax attributes of those IRA assets. I said before that when money is withdrawn from an IRA account, you pay income tax on it at your ordinary income tax rate. Well, individuals generally have lower effective income tax rates because of the marginal tax brackets that apply. If you name a trust, for example, and you want to have trust protection for a young child or a loved one or child that isn't good at handling money, even if they're an adult, or maybe you're doing this for estate tax avoidance objectives, like I mentioned before, the the IRA dollars that are held in a trust are typically taxed at a higher effective income tax rate because the income tax rates in a trust, for example, the top rate of 37% from a federal standpoint starts at it's about $16,500 of income. So it's a more compressed marginal system. And if those IRA dollars, when they're withdrawn or withheld in trust, a higher effective income tax rate is typically paid. So that's the trade-off: is higher potential income tax dollars paid if the assets are held in a trust versus your asset protection or estate tax minimization objectives. Again, not an easy answer. It's the Secure Act has really created a little bit more of a paradigm when it comes to these assets because of the loss of that stretch IRA feature. So when you're thinking about your own estate plan, how to structure your own assets from a titling standpoint, beneficiary standpoint, it's really important to sit down with someone and understand, really the trade-offs and pros and cons of these different approaches. And it's going to be unique to everyone. So this is just another visual of all those decisions that I laid out. Again, if you're a spouse, you have really maximum flexibility and control if you're named as the outright beneficiary, but it's possible to name a family trust or credit shelter trust, for example, as the beneficiary of that IRA account if you want to provide protection for your spouse and you want to preserve those assets in a trust so those ultimately go down to your own children or your own intended beneficiaries. This is really common in a blended family situation, by the way. We encounter this all the time. And like I said earlier, if you're doing this sort of planning, you want to make sure that family or credit shelter trust or marital trust even is structured properly to maximize income tax deferral and minimize overall income taxes paid by your family. Children, most adult children have the 10-year distribution limit, but many parents do want to protect assets for their children in the form of a trust. So remember that can be done. You can name a trust as beneficiary for a child too, but you have those income tax trade-offs that I described earlier. And the structure that you put in place for your children might not be the same as you might put in place for a young grandchild in the event that a child predeceases you, and now young grandchildren are named as beneficiaries. So oftentimes, parents like the idea of distributing assets to their children outright and free of trust, but knowing that the grandchildren are younger, they want to have a trust that continues for their benefit. So the big takeaway here is that you have to really think about those beneficiary designations, because if you don't have the beneficiary designations listed properly, your asset protection and income tax goals might be completely defeated. And this is something I think, Michael, you'll agree, often gets overlooked because people assume that when I have a trust or a will in place, it takes care of everything. Beneficiary designations pass independently of what your written estate plan says. So you have to look at each individual asset and make independent decisions at each account level. So I know this was a lot, but these are really important topics. And this is just another summary of some of the decisions that go into proper alignment of beneficiaries. I want to turn it over to you, Michael, so you can give our listeners some insight into how to invest and just some information on wealth advisory.
Yeah, thank you, Dom. I certainly appreciate the introduction. So first and foremost, it is a pleasure to be with all of you here today. And we certainly appreciate the opportunity to discuss a topic that can be certainly emotional and very financially important, which is the idea of inheriting wealth. So my name is Michael Goldstein. I'm a certified financial planner and financial advisor here at Savant, based out of our Lincolnshire, Illinois office. So an inheritance can create an opportunity, but it can also bring many questions, uncertainty, and of course, responsibility. So today we'll just talk a little bit about certain ways of asset allocation, taxes. Of course, some of this might echo what you said, Dominic, a little bit regarding taxes, but taxes are a very, very important aspect of this. So that's why we seem to talk about it ad nauseum. So let's start with the big picture here. So before making major decisions, we really want to take a step back with this. So when someone receives an inheritance, there is very oftentimes pressure to act quickly. But in many cases, the very first thing you should do is really just pause and get organized. And some questions you'll really want to ask yourself, would be, what did I just inherit? What are the tax implications? Do I need income from this money? Should I pay down debts? How does this fit into my overall financial plan? What would my loved one have wanted me to do with these assets? So inherited wealth really should not be viewed in isolation, and it really should be integrated into your overall financial picture. So your goals and objectives should really be the key factor of how your assets are invested and managed. So with this slide, looking at some asset allocation details here. So how the inherited assets are invested may have a major impact on your long-term outcomes. So asset allocation is really the mix of investments in your portfolio. So that just might include stocks, bonds, cash, alternatives, or any other investments. So the right allocation really depends on a number of different factors, and that would include your goals, of course, your time horizon, your risk tolerance, your income needs, your tax situation. So whether the inheritance is intended for spending, investing, gifting, or legacy planning, those are quite a few factors that you really want to consider. One of the most important decisions is simply not what you inherited, but how the inheritance should be positioned for your life. So why does diversification and asset allocation matter? So diversification really can help reduce the risk of having too much money tied in one particular company. If you want to go back real quick, Dom, sorry. So many inheritances actually come in concentrated form, and this could be, a single stock, a family business, real estate. So many of us will inherit our parents' homes one day, or a retirement account, which is usually the most common. So an important thing to consider is that a portfolio that was designed for someone else is not necessarily designed for you. So diversification does not really guarantee a profit or prevent a loss, but really it can help create a more balanced investment experience. So really here, a key item to remember is that a portfolio that made sense for someone else may not make sense for you. So just to kind of understand the differences between stocks, bonds, and alternatives here. So with stocks are generally the growth engine of a portfolio, and they really help the inherited wealth grow over time. But they also come with some volatility, as we have seen over the last couple of years. So stocks may be appropriate when the money has a longer time horizon, or when the investor is really just seeking out growth. And stocks can certainly be powerful over time, but the amount that you own really should be considered with your overall financial plan. Now, with bonds can certainly provide some income and stability and risk management, of course, but bonds may help reduce volatility and provide a cushion during difficult stock market environments, which we have seen this year in April and last March, actually. So bonds can especially be important, when there's income needs, or you're nearing retirement, or just simply to preserve capital. So bonds may not be exciting, as they really aren't so far in 2026, but they can play a very, very important role for inherited wealth. So alternative investments is really the third leg of the stool here, and alternatives may really provide a third layer of diversification, or in terms of reducing risk with the portfolio. And alternatives might include things like real estate, private credit, commodities, managed futures, or other non-traditional strategies. And they may or may not be appropriate for everyone. So when used thoughtfully, alternatives can be a tool just to make the portfolio a little bit more resilient. Next slide, please, Dom. So I want to briefly explain what the efficient frontier is. Now, bear with me here. This is a little bit of a technical concept, but we certainly believe here that it could be a very, very important tool. So the efficient frontier is really a way to show the relationship between risk versus return. And it really helps investors understand how to build a portfolio that seeks the best possible return for a given level of risk. So every investment has some level of risk and some expected rate of return. And really what the efficient frontier is just a visual concept that compares different combinations of investments such as stocks, bonds, cash, and alternatives. So portfolios that fall on the efficient frontier, which is on the curve that you see, is really the most efficient and really what we strive to accomplish. And portfolios that you might see fall below the efficient frontier may not necessarily be as efficient. So in simple terms, the efficient frontier really helps us ask a very important question. Am I being properly compensated for the risk I am taking? And the one thing to note here at Savant, we can help you actually determine your current risk versus your return level in your own portfolio and where it might lie on the efficient frontier. So how does this relate to inherited wealth? Well, when someone inherits wealth, they may receive assets that were designed for someone else's goals, as I previously mentioned, someone else's risk tolerance or tax situation or their income needs. So that inherited portfolio may not be efficient for the new owner. So for example, here, the portfolio may be too heavily concentrated in one particular stock, maybe too conservative for a younger beneficiary, maybe too aggressive for someone nearing retirement, or even too concentrated in one particular sector. We see this all the time. And it may not be aligned with the beneficiary's need for income or liquidity. So let's talk about how this relates to your overall plan. So the efficient frontier is really not meant to create a perfect portfolio on paper. It's really meant to kind of help thoughtful decision making. So a good financial plan would consider how much growth is needed to reach my goals. How much risk can the investor tolerate? How much income is needed for the portfolio? Very important question for someone who's nearing retirement. Tax impact, your time horizon, your estate planning goals, charitable giving, and even your liquidity needs. So the goal here is really not to build the most aggressive portfolio or the most conservative portfolio. The goal is really to build a portfolio that gives the investor the best chance of achieving their goals while taking the most appropriate amount of risk. Next slide, please, Dom. So, Dom, you spent a lot of time talking about taxes, and that's something we want to be extremely mindful of. So taxes can have a major impact on how much of the inheritance you actually keep. So tax treatment depends on the type of asset you inherited. So looking at this slide, so there's pre-tax, taxable, and Roth money. So for the pre-tax, that could be an IRA. We also have Roth IRAs on the right side, your taxable investment account, real estate assets, life insurance, trust assets. So some inherited accounts may have required distribution rules. So some assets may receive a step up in cost basis. Dom, I know you mentioned that earlier. And some accounts may create taxable income when money is withdrawn. And these are all things that we want to plan out and pay attention to. So before selling, withdrawing, or reinvesting inherited assets, it's extremely important to understand the consequences of everything that you inherited. I want to briefly talk about some common mistakes that we see with inherited assets. So a thoughtful plan can help avoid some very, very costly emotional or financial decisions. Now, some of these mistakes might be spending too quickly, leaving too much money in cash for too long, taking a large taxable withdrawal without planning, keeping a portfolio that was designed for someone else. That one is extremely common. We see that all the time. Failing to update your own estate plan, ignoring debt, insurance, or retirement planning opportunities. And a key one here is making decisions while grieving. And this is a very difficult thing. Everyone has their own unique grieving process. So, we do encourage you to take your time if you're going through that process. So an inheritance can really be a blessing, but also really needs to be handled with care. Next slide, please, Dom. So what do we do? So here at Savant, we really want to create a personal action plan. So inherited wealth could really be connected or should be connected to your own goals, as we previously talked about. So a good action plan or a good financial plan would be reviewing your full financial picture, I would say. Understanding the type of assets that are inherited, extremely important. Identifying tax issues, creating your own investment strategy, reviewing your retirement goals, of course, evaluating debt payoff opportunities, updating your estate documents, and considering gifting or charitable giving. There's nothing here that's more important or less important than the other. They're all extremely important and all things that should certainly be considered when inheriting assets. And really, the goal is to turn inherited wealth into a thoughtful plan that supports your life, your family, and of course, your future. Next, Dom. So really here at Savant, so investing is only one small piece of the puzzle here. And as you can see, there's a number of things, a number of different services that we offer. So while investment management is extremely important, true wealth management goes far beyond building a portfolio. So at Savant, we take a comprehensive approach that looks at the full financial picture. And as you can see, there's quite a few things, and we did allude into some of them earlier. But when someone inherits wealth, the natural first question that comes up is, how should we invest in, right? Next slide, Dom. So we have a concept here called your ideal futures, and these are basically the key areas of financial planning that we really focus on here at Savant, which are, of course, I know I mentioned them before. Retirement income, building a paycheck for yourself. So we're going to retire at some point. How do we recreate your paycheck? Tax planning, estate planning, trust administration, charitable giving, family wealth transfer, insurance needs, business or company retirement plans, legal coordination, and of course your long-term financial goals. I hope I'm not overwhelming anybody by discussing all these different aspects of financial planning, but it is extremely important to recognize all of these things if you do have a substantial inheritance coming your way. So, at Savant, we believe, like I said, investing is just really one piece of the puzzle, and comprehensive wealth management means, helping us make smart decisions across all of these different lines and not just investing. So really the goal is not just to manage money. I would say the goal is to help us make better decisions with our money by considering all these different factors. And, a portfolio tells us what you own, but a financial plan really goes much deeper about what we're trying to accomplish. So next slide, down. So estate planning and administration, that's one thing that, that's kind of what we're focusing on here today. The next slide, this is just a sample of what we use in our financial planning software. So everyone who we work with will receive a net worth statement. And it's important. This is one of the most important things that we need to address early, just so we have a clear understanding of exactly what it is that we're working with. Because without doing this first, it's really kind of hard to work on planning on all those other different aspects. So this is something that we have with our software. We'll know your investment assets and any other assets you might own, which would be your home and any other property you might have. We'd also include your liability. And when we look at all this together, that's what would give us the net worth. Moving on, Dom. And the last thing I'll actually focus on today, what we like to do with a lot of folks who we meet with, we like to do what's known as our ideal futures health assessment. And really what this is, it's like a 10 or 15 minute survey where you'll take some time and start to address the 10 key areas of financial planning that we previously discussed. And what this will do is actually give us and yourself a much clearer picture of what really needs to be addressed and focused. And if we could see on the next slide, once the questionnaire is actually completed, there we go. So we'll actually get an overall score as well as a score on the 10 key areas of financial planning. So a lot of folks that come to us don't need services on every aspect of financial planning, as we can see on here. So, business succession planning, and this is just a sample, is rated a 10. Investment planning is rated a 10. Debt management is rated a 10, which is fantastic. So that tells us that things are in good working order in those areas of financial planning. But as you can see, there's a number of other areas here on this little wheel that do need to be addressed. So for example, retirement planning, which is a big one. Income tax planning, education planning, and estate planning are usually one of the more important items. And by looking at something like this, so that's our goal in working with you, and certainly something that we'd be happy to take a look at. So with that said, Dom, I'm going to turn it back over to you just to discuss the estate planning considerations for generational planning.
Yeah, thanks, Michael, for your insights. There's one thing I never really thought about, but when you inherit wealth from a loved one, you're inheriting somebody else's portfolio, and those I thought that was great. That those holdings made sense for mom or dad, but do they make sense for you? I never really thought about it that way. So a couple more items as we wrap up our discussion. We focused a lot on understanding the unique income tax attributes of the assets that you inherit, the structure, what that might mean for the design of your own estate plan. And we're going to turn our attention on just really planning for generational wealth. And that has a different meaning for everyone. But one thing that is universal is just trying to create an orderly and efficient plan after you're gone to dispose of the inherited wealth, the assets that you've accumulated, and just make things as easy as possible and clear for your family. So being organized is one of the greatest gifts that you can give outside of the financial wealth that you're going to bequest. Your legal documents, your wills, trusts, power of attorney documents, those are important because they list your fiduciaries, agents, executors, trustees, but they don't capture other important information like who to contact if something happens to you or your spouse, uh, where important documents are located, some of your family values, context for why you designed the plan, and ultimately what the family wealth that you're bestowing on your loved ones really means, right? The money is often a tool to do good things with, right? And you might value family and friendship. So don't forget about these guiding principles. Getting organized, providing letters of instructions or ethical wills. I think it's all very, very important. I mentioned fiduciary earlier. We talked a little bit about trustee in our diagram, right? Are you the trustee? Are you going to somebody else to access your inherited wealth? Well, trustee selection and that structure that I alluded to, what the trust document actually says for how monies can be accessed, extremely important. So when you're thinking about your own estate plan, really think about the right people that are going to be in charge in the future, and that could be your adult children. It could be a parent or a sibling if you have a young family, or maybe you don't have children or a surviving family at your death. One thing that's becoming more common is the concept of appointing an independent or corporate trustee in estate planning documents, because that can promote family harmony. It can remove administrative burdens off the shoulders of your loved ones. Being a trustee is a thankless job. For those of you that are currently in that role, I think you know what I'm speaking about. But again, having the right lineup of fiduciaries, thinking about these issues, are the people that you're naming in your document the right people? Are you creating a situation that might be overwhelming for others? So if you're interested in speaking about options or the potential use of an independent trustee, we'd love to sit down with you and talk about your own situation and some of the options out there. Asset protection, again, that's the right structure to protect the beneficiary, sometimes from themselves, but more often than not from outsiders trying to take advantage and access that inherited wealth. A lot of people don't remember or understand what their estate documents say as far as how those trusts are going to continue or not for their own loved ones. So again, just a good time to review your own estate plan, understand how your wealth is going to pass in the future. Yeah, I mean, distribution standards are key. There's like health, education, maintenance, and support. Our first one. I mean, that's often very common that those words come from the tax code. It's an ascertainable standard that can keep assets out of a beneficiary's estate. But there might be other very particular and important things for you to put into your document that gives your trustee or named fiduciary a little bit more guidance, like a down payment on a home, money to start a business, weddings. You really have flexibility when it comes to designing the terms of your own estate plan. And if you're the inheritor of wealth and you have your money in a trust, basically for your benefit, you having a good understanding of what these terms mean and your access is also very important. So these are just examples. Again, everybody's situation is unique. The right distribution standards are going to really be dependent on what your objectives are and what protections you want to put in place. Flexibility is really key. We talked about trustees, executors, distribution standards, but a trust protector is a person or entity you can name in your document that allows for trust to be amended posthumously by this named individual. They can remove and replace trustees. This is important because if you have long-term trusts in place, the future is uncertainty, and having a mechanism to allow changes in a changing world and changing beneficiaries situation is very, very important. So we often discuss these concepts too, especially again, if you're going to have a longer term trust arrangement. We'll end here with a couple of pitfalls, and we've got time for questions and a few other items, and these are meant to recap some of the concepts that we discussed. Michael had a really great one on investments, right? Holding the wrong investments that don't make sense for you. Maybe putting the wrong assets in the wrong tax buckets, just to inefficient income planning. But we talked about this earlier. Failing to take the proper required minimum distributions from inherited accounts can be dire with penalties. Commingling inherited assets with marital assets, you can lose separate property status and end up inadvertently subjecting those inherited dollars to a divorce settlement. We talked about basis step up. A lot of times this isn't done, shockingly, but if you inherit an after-tax asset like a trust account or a brokerage account, make sure before you sell anything in that asset and put it into a portfolio that better meets your needs, that the step up was actually done by the prior account owner or custodian. Again, failure to updating your own estate plan, very critical misstep, because your wealth can cause you to outgrow the legal terms of your own written documents, and that can lead to unintended income or estate tax consequences and just asset protection issues for your loved ones. And then lastly, this is the big common one. Beneficiary designations are often not updated when they should be and aligned properly with the overall estate plan objectives that you might have. So just some good takeaways. Reach out and let us know if you'd like to have a 15-minute complimentary introductory call with one of our Savant advisors. On your screen, there should be a link that you can click in the chat box if you'd like to schedule that call or learn more about Savant. We'll have some time for questions, and we really thank everybody for joining us today on our call. We're going to try to get through as many questions as we can, but if we can't get to all the questions, we'll circle back on those that we can't answer. Michael, what are you seeing coming through the question box?
Yeah, I got a real good one here. How should I think about investing inherited assets differently than the money I saved myself? That's one of my favorite questions. And really, and as I mentioned before, an inheritance should not be viewed in isolation at all. So I would say the first step here is to understand how it fits into your overall financial picture, right? So, before making investment decisions, we would really want to look at your goals, your current assets. We looked at the net worth statement before. Your income needs, your risk tolerance, your tax situation, time horizon. So quite a few things you're really going to want to take a look at. So sometimes inherited assets can help strengthen retirement security, and that's kind of one of the bittersweet things about it. But other times they may create an opportunity to pay down debt, increase cash reserves, funded education, or help support family members. So like I said before, the key here is really not to rush on this. And the inheritance should be, really incorporated into, a thoughtful financial plan, so the investments are aligned with your own strategies, I'd say.
Thank you for that. We're at time for our scheduled webinar, but I'm going to try to answer this one very quickly so we can get everybody on with their days. Can I add an IRA that I've inherited from a loved one to my own IRA account? We spoke about this a little bit. It depends on what type of beneficiary you are. If you're a surviving spouse, that option is available, but if you're not a surviving spouse, you cannot commingle or add inherited IRA dollars from a loved one with your own IRA account. It has to remain in an inherited or beneficiary IRA account because those distribution rules are very, very different. Thanks again, everyone. Again, we'll get back to those that asked questions that we didn't have time for today. At any time, if you're looking for more information about Savant and what we do, we invite you to check out our website at www.savantwealth.com to learn more. And please sign up if you're interested for a complimentary 15-minute call with one of our advisors. And we also invite you to sign up for our retirement readiness e-newsletter, where you can get a lot of other great information and topics to consider. Thank you, everyone. We'll see you next time.
Thank you.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.